Welcome back. You're watching Stock Picks, and today we unpack a Tencent, a Constellation Software, and Alphabet with Anchor Capital, Seleho, Tsatsi. Seleho, a pleasure. Good afternoon to you.
Thanks for having me.
Very keen to maybe get your thoughts on why overall we've chosen these counters. We'll get into the detail in a jiffy. Is there a specific theme we're looking at here?
Yeah, so unintentionally there is a theme here, and it's probably technology. All three are companies that are very technology focused. But I'd say besides that, all three are businesses that have shown the ability to compound their earnings at decent rates. We're talking 20% plus over quite a long period of time. And we think that they can do something similar or similarly attractive going forward.
Let's start off with Tencent, the world's biggest gaming company, of course, operator of China's WeChat, and also, I guess, here in South Africa, Naspers and Process acting as a proxy for it here locally. Talk to us about this counter and even, the returns that you make mention of.
Yes, I think Tencent is a business that many of us are familiar with, either as investors and probably some of us just as consumers or users of some of their products. So, as you said, video gaming is about 30% of revenue, but because it's a very high margin business, it's a larger proportion of profits. In addition to that, they've also got advertising, online advertising, social networks, and then fintech and payments and other businesses, which is mostly cloud. So it's quite a diversified, I suppose you can call it play on Chinese technology. What we like about it is that a lot of the businesses within Tencent benefit from network effects. So, for example, WeChat has over roughly 1.2, 1.3 billion users at this point. Growth has slowed for WeChat, but it's quite valuable in the sense that, similar to what we've seen with WhatsApp or Facebook, Instagram, any of these social networks, the more people that are on the network, the more valuable the network becomes to the users. So there's not much use in having a social network with 10 people, spread around the world. Generally, you want the networks with the largest amount of people, and you see that with Tencent. The share price has been under a tremendous amount of pressure really over the past couple of years for several reasons. We know that Chinese technology has been under pressure. There's been regulation that has clamped down on not just Tencent, but the broader sector as a whole. But we need to keep in mind that operationally, the business has actually done quite well for the first 9 months of 2023. We still need to hear their fourth quarter results, but they grew their free cash flow by over 100% in the first 9 months of last year, and they grew their earnings per share by about 34% for the first 3 quarters or 9 months of last year. So yes, there is a huge amount of noise around the share price. It is very volatile and it can test one's stomach. But if you look at actual underlying performance, we have definitely seen operational performance turn a corner for this business.
I'm also ask you, Seleho, here about the valuation around Tencent. Is it trading at a discount that doesn't necessarily reflect, the value that's within the business?
Yeah, so there's many ways of approaching the valuation for Tencent. One way we can look at it is a simple PE ratio, where we estimate that it's on low double digits of about 11 times or so. That doesn't include stripping out the investment portfolio that they have. So the market cap of Tencent as a whole is about $340 billion, but they have an investment portfolio of roughly $100 billion, which the market isn't really giving them credit for, and there's perhaps a few reasons for that. But if we just look on a PE basis, it's at low double digits. You can also look at it at a free cash flow yield. It's approaching about 10% or so. And as we said, free cash flow is, at least this year, has grown very strongly. It's doubled after a weak year last year. So if you compare the valuation to what you can see in US counterparts, there's a huge disparity. Now, we don't think that this company, for example, Tencent, should necessarily trade in line with for a company like Meta or Alphabet, but we do think that the gap between the two has gotten quite extreme.
I must also ask you, I think reading about it, their chairman and CEO, Pony Mars, come out to say that, they don't believe that they've embraced AI at the level that they can. That tells me that, Tencent is yet to really bring AI into its operations from WeChat through to the gaming to whatever extent that might be Seleho. But that tells me of a lot of upside here because of just how powerful AI is and its ability to augment any technology. Does that bode well for the investment case for them in the future?
Yes, you make a great point. Ponima was speaking briefly, and he did mention that. And I think one of the things he said is that they've had some progress recently, Tencent as a company in AI. So he now feels comfortable saying that they are no longer, lagging badly in AI versus some of their counterparts. But perhaps reading between the lines, he still doesn't feel that they're leading the charge within AI. I think what's interesting is that most of the, I suppose, developments in the AI world have come from the US. So if you look at China, at least up until recently, it's been more of a I don't want to use the word copycat, but more of a mirroring of what you see from the US in terms of these large Chinese tech companies. I think really, if you look at the valuation or the potential cash flows we see from Tencent, AI will be a part of a contributor to those cash flows in terms of their gaming business, what they're going to do with WeChat, what they're going to do with advertising. But we're not baking in that they're going to lead the charge or come with or lead the revolution in AI. It's more just about the existing business being revalued and growing over time.
Very fascinating stuff. Let's move on now and speak about Constellation software. It's an interesting one. Is it a hold co of this company, Seleho?
Yes, it is. It's a holding company consisting of a myriad or a constellation, hence the name, of software businesses. Constellation itself is domiciled in Canada, in Toronto. Having said that, Canada is quite a small part of its business. It's much more US focused. So you can almost think of it as an American company in terms of the companies that it owns. And what Constellation really focuses on is acquiring and holding for life. So they don't buy and sell, but they buy and hold these software businesses that have what they call vertical market niches. So they're looking for businesses with switching costs that deliver value to the users of the software that would really be inconvenient for the user to switch to something else. So they don't own Microsoft, but an example would be, for someone who's built up expertise in Excel, to switch to another software provider of spreadsheets would be a bit of a nuisance. Or if you think of something like Photoshop from Adobe, once you've built up knowledge in how to use Photoshop in Creative Cloud, you don't really want to switch. That's the kind of thing they're looking for, but they're doing it in businesses that are much smaller. So they're buying businesses that are, hundreds of millions of dollars usually, or sometimes smaller. Whereas obviously Microsoft and Adobe are tens, hundreds of billions of dollars, or in Microsoft's case, multi-trillion dollar company.
I must ask you, Sila, very fascinated by the buy and never sell strategy. It's not something you hear about often, and most times, investors are happy to let go of a business should it no longer give them the returns they anticipated. But the kind of due diligence you would have to do for a company that you never intend on selling. I'm just keen to get your thoughts on that one.
That's a great point. I think to be able to buy a business with the view of never selling, first off, you have to be very comfortable regarding the quality of the business or the stability of earnings from that business. So you're unlikely to be buying businesses that have volatile earning streams or cash flow streams. So I think that cuts out quite a large portion of their investable universe. What they're also looking for are, as I said before, businesses with essentially competitive advantages or moats, largely in the form of switching costs. And so I think they're able to take care of the never selling part of the investment process through their buying screening. Or at the first part of their investment process, when they screen what they're looking for. So I think it's quite a stringent set of criteria that they're looking for. And what would probably take many people by surprise is that I believe they're a bit more strict or valuation focused than investors would think. You think of a technology focused acquirer, you would think that such a holdco would be maybe a bit more relaxed on valuation. But if you read the letters of the CEO and one of the co-founders, Mark Leonard, he does touch on valuation quite regularly throughout those letters. So valuation cognizance is something that they have.
It's a very interesting one, a fascinating one that we don't hear about often. Let's talk about Alphabet now, because Alphabet came out with a set of numbers overnight, and I think the markets have punished them unfairly. But I'm keen to get your thoughts here because they actually, exceeded market expectations, but for some reason, there was a bit of a sell-off.
Yes. If you look at how the markets reacted, the share is down roughly 5 to 6% pre-market. I checked just before we started the show. It's at about $144 per share now. You would certainly think that the results came in subpar, but if you actually look at the numbers, I think they had a very decent fourth quarter for 2023 and a decent 2023 overall. This is a business now with over $300 billion in revenue. They're doing close to $70 billion in free cash flow, over $1 trillion in market cap, and they're still growing their earnings per share at the high 20% level, which is astonishing when you consider just how large of a business this is. So I think we need to keep that in mind. But also, the share was up 58% in 2022. So perhaps part of this aftermarket reaction to earnings last night is just profit taking and a bit of maybe nervousness around the run that the business has had or the share has had. But I think fundamentally, you still have a business with very long runways for growth in things like the cloud, things like YouTube advertising, and very defensible moats. So still quite an attractive investment opportunity in our eyes.
I also want to get your thoughts on their AI offering. Of course, ChatGPT was maybe first on the scene when it comes to generative AI, but we've learned with tech that the first on the scene isn't always the best on the scene. Sometimes a slow and steady really does win the race. But I'm wondering if Alphabet is catching up here. ChatGPT already a bit of a household name.
Yes, I think when ChatGPT came out at the end of 2022 and took the world by storm, throughout 2023, especially in the first quarter of last year, a lot of investors were looking at Alphabet and Google and almost saying, okay, what are you going to do? But we need to keep in mind that a lot of the innovations that started at OpenAI came from Google. So not to take anything away from OpenAI, but the transformer model, for example, that actually started at Alphabet or Google. Google owns DeepMind, which is behind some of the most impressive AI innovations that we've had over the last 10 to 15 years. We think of things like AlphaGo, which was a big breakthrough. And some of the co-founders, at least one of the co-founders of OpenAI, used to work at Google. Now, this is not to take anything away, again, from OpenAI, but it's just to point out that Alphabet or Google is perhaps not as far behind as one would initially think. They definitely have had some issues. For example, their rollout of their version of ChatGPT, which is Bard, was I think had some issues, we can say, technically when it first came out. But I think in terms of computer science knowledge or innovation, I think or research, they definitely are competitive. Now, one of the worries may be that for a business with roughly 180,000 employees in total, perhaps they've gotten to a size, and you've even seen some of Alphabet's employees or Google's employees. There was a post that went viral on LinkedIn just questioning whether the business had become too bureaucratic, too large, too slow. That's definitely a concern, but I think it's something that they are also aware of. So I think they have. I don't think we can count them out just yet.
Before we move away from them, we don't have much time, but I really also want to ask you about their cloud business. It's clear that cloud is king, but their advertising business has suffered a little. I'm keen just to get your thoughts on that dynamic as well.
Sorry, I didn't catch the last part of your question.
Just asking about advertising taking a bit of a knock, but their cloud business really being, their flagship part of the business right now.
Oh, yes, yes. So I think what is encouraging for the cloud business is that it is now profitable. So it had a 9% operating margin in this most recent period. Up until recently, it was loss making. It's growing at 26% in terms of top line growth for the cloud. Now, that's perhaps disappointing for investors when compared to some of its larger peers, which are posting stronger growth numbers at larger scale. So perhaps there is some concern there. But I think they are making decent progress both on the top line and bottom line, as I said, in terms of that progress with margins for the cloud. On advertising, we need to keep in mind that Google or Alphabet, their share of online advertising is quite large. One of the points they made on the call last night was that their advertising revenues in 2023 were $100 billion larger than they were in 2019. So they've grown that ad business by $100 billion over 4 years, which is astonishing when you think about it. For example, just to illustrate the size of that, Meta Platforms' total revenue, which is largely all advertising, was about 110 or so billion dollars last year. So Google really is a sizable part of the online ad market. I don't think we can expect the kind of growth they had maybe 10, 15 years ago in the ad business, but I think we should still have pretty decent defensible growth going forward.
Now today we don't have much time left. I want to get straight into our educational segment today. Talk to us about the 4% withdrawal rate.
Yes, this is from a fascinating study done in 1998, where three researchers looked at the question of how much can you withdraw safely from a retirement portfolio and not run out of money or end up needing to eat cat food at the end of your retirement day. So what percentage of your portfolio can you withdraw a year? And they found that 4% over 96% of the scenarios they looked at was able to withstand the investor was able to live off of that portfolio till the end of their retirement or retirement life in 96% of scenarios. 3% was virtually guaranteed to last through your retirement. And so the idea is if you can accumulate assets equal to 25 times your living expenses, then you are most likely going to be able to live off of that portfolio to the end of your days.
Really, really fascinating stuff. Shirley sent me down a rabbit hole. Oh, thank you so much, Seleho. Today has been fun. Keep well. That was Anchor Capital's Seleho Tsatsi.